What if one product quietly changed how the entire world invests? Not with hype, but by redesigning how markets work. To understand SPY, we go back to one of the most violent days in market history, Black Monday, October 1987. Global markets collapsed in hours, panic spread fast, and regulators at the SEC began asking a simple question. Why didn't investors have a single instrument to track the broad market in real time like futures already did? That question planted the seed for something new. Fast forward to January 1993. On the floor of the American Stock Exchange, the first U.S.-listed exchange-traded fund launched. Its ticker symbol is known as SPY. Built through collaboration between State Street and AMEX, SPY was designed to track the S&P 500 of America's largest companies in a single trade. But behind the scenes, it was far from simple. Every share of SPY had to be backed by real securities in the exact proportions of the index. That meant moving and reconciling hundreds of positions daily, with tight operational timing between market close and next day open. In the early days, the system was untested. No one was fully sure it would scale. But remarkably, it worked perfectly. And once it did, adoption spread quickly from institutional investors to global pension funds, seeking efficient exposure to U.S. equities. For the first time, investors could buy the entire S&P 500 in a single tradable security. Over the next 3 decades, ETFs exploded in scale. As of 2026, there are more than 14,000 ETFs globally, spanning equities, bonds, commodities, and strategies. Yet SPY remains one of the most traded ETFs in the world. In fact, it often trades more volume than even the largest individual stocks in the index, demonstrating its role as a core liquidity hub in global markets. That liquidity has been tested in real crises. After the September 11th attacks, when U.S. markets shut for 6 days, SPY helped investors re-establish price discovery when trading resumed. During the COVID-19 shock in 2020, SPY became the first ETF to surpass $100 billion in single-day trading volume, highlighting its role in periods of extreme stress. In moments like these, SPY doesn't just reflect the market, it helps anchor it. Today, ETFs like SPY are no longer niche tools. They are core infrastructure. They are used for liquidity management, diversification, risk control, and efficient portfolio construction. And while ETFs still represent a minority of global investable assets, adoption continues to rise, with financial advisors increasingly integrating them into portfolio design strategies. What started as a solution to a market structure problem has now become a global investing standard. From institutions to advisors to individual investors around the world, and yet the biggest surprise of all, SPY was never just about tracking the market. It was about making the market accessible. So the real question isn't what SPY is, it's this: how many other parts of investing are still waiting to be reinvented?